Bank of America just told its wealth management clients that a 1 to 4% allocation to Bitcoin is now appropriate, not as a speculation on the side, but as a formal part of the portfolio. This is one of the largest banks in the United States telling millions of affluent and high net worth households that Bitcoin is no longer taboo. It is now a sanctioned source of return and a legitimate hedge for people caring about staying ahead of inflation and innovation. Let's break down what changed, what the numbers actually look like, and how you should be thinking about this as Bitcoin enters the center of Wall Street wealth management. So first, the policy shift. Until now, Bank of America's wealth advisors were basically in a gag order on Bitcoin. If a client asked for exposure, they could route them into a product, but they were not allowed to proactively recommend Bitcoin. It was do not bring it up unless the client asks. That era is now over. Their chief investment officer, Chris Hizzy, is now telling advisors that a 1 to 4% allocation to Bitcoin can be appropriate for investors who care about thematic innovation and who understand elevated volatility. 1% at the low end for conservative clients and 4% at the high end for clients with a higher risk tolerance. That sounds small, but in portfolio terms, it's massive. Because we're not talking about a crypto hedge fund. We are talking about the Merrill platform, the private bank, and Merrill Edge. Over 15,000 advisors now have top cover to bring Bitcoin exposure into the conversation with their clients. To understand how big this is, you have to do the math. Let's keep it simple and conservative. Suppose Bank of America wealth clients collectively have $1 trillion in eligible assets where this guidance actually bites. In reality, the number is higher, but we'll round down. If those portfolios average a 2.5% Bitcoin allocation across that base, halfway between 1 and 4%, that is $25 billion pointed at this sector. Now, let's assume, again conservatively, that half of that ends up in Bitcoin-specific products rather than a blend of crypto tokens. That is $12.5 billion of incremental demand for Bitcoin. At a $100,000 Bitcoin price, $12.5 billion buys 125,000 Bitcoin. Daily issuance after the last halving is about 450 Bitcoin per day. Across a full year, that is roughly 164,000 new Bitcoin mined. So a single conservative implementation of Bank of America's new guidance, if actually followed by clients over time, would absorb almost 3/4 of an entire year of new supply. And that's just one bank. Now layer on the fact that Bank of America is not an outlier, it's actually a late adopter. Morgan Stanley has already floated a 2 to 4% allocation range. Fidelity suggests 2 to 5%, and BlackRock has talked about 1 to 2%. Every major asset manager is landing on the same number, a small single-digit slice of the portfolio that goes into Bitcoin and related vehicles. You're watching the birth of a new model portfolio rule of thumb in real time. The other important part of this shift is behavioral. For the last decade, wealth advisors could keep Bitcoin in the too hard bucket, whether it's too volatile, too unserious, or too early. And now their chief investment officer is saying you're allowed to recommend this, and here is the band that we're comfortable with. That matters because advisors are gatekeepers. A lot of wealthy clients won't buy anything that's not explicitly blessed by their advisor and the home office. Bank of America just moved Bitcoin from the fringe onto the main menu. They're also very clear about who this is for. Clients who care about thematic innovation and clients who can handle elevated volatility. In other words, people who understand a 60-40 stock bond portfolio is not built for a world of persistent fiscal deficits, rolling inflation, and rapid technological change. If you're an advisor, here's how the math works in practice. Historically, adding a small slice of Bitcoin to a traditional portfolio has improved risk-adjusted returns, even if the allocation is tiny. Imagine a 60-40 portfolio that returns 6% a year with 10% volatility. If you carve out 3% from bonds and put it into an asset that compounds at, say, 20% with high volatility, the overall portfolio volatility barely moves, but the long-run return steps up substantially. That's the entire game. A few percent for a long time dramatically changes the end state. If you were a client on the other side of that table, this should change how you frame Bitcoin in your own mental model. The question is no longer, is Bitcoin going to 0 or to a million in a vacuum? The question is, does a 1 to 4% position improve my odds of preserving and growing purchasing power over the next 10 to 20 years? From an adoption perspective, this is yet another brick in the wall. You already have US spot ETFs holding well over 1 million Bitcoin. You have corporations using Bitcoin as a reserve asset, with Strategy recently hitting 650,000. You have sovereigns quietly accumulating and openly discussing strategic reserves. Now you have one of America's largest wealth platforms giving a green light to allocate. This plays into what I talked about yesterday with Vanguard now opening up the floodgates to allow its clients to purchase the spot Bitcoin ETFs. All of that is converging on the same idea, that Bitcoin has earned a seat at the asset allocation table. Now, how should you think about this if you're watching at home? The first is sizing. If a massive wealth platform is telling its wealthiest clients that 1 to 4% is appropriate, That's a good reference point. Most people don't need to be at the high end of that range right away, especially if your income is not stable or you don't have other liquid assets. The second is time horizon. This kind of guidance only makes sense if you think in decades rather than weeks. The reason a 3% allocation is powerful is not because Bitcoin will move 10% next week. It's because if Bitcoin continues to monetize over the next 10 to 20 years, a small slice of your net worth will be tied to the best performing monetary asset of the era. The third is flows. The allocations that we're talking about won't hit the market in one day. Advisors need to be educated, clients need to be onboarded into new products, risk teams need to sign off. But once these pipes are built, flows tend to be sticky and systematic. Rebalancing alone becomes a structural bid underneath Bitcoin. If a client decides that 3% of their portfolio belongs in Bitcoin and Bitcoin rips higher, the advisor trims back to 3%. If Bitcoin corrects, the advisor tops it back up to 3%. That simple mechanical rule creates a base of consistent demand. Bitcoin is no longer being framed as a lottery ticket, it's being framed as a strategic asset that improves a portfolio's long-term resilience. And that is why banks are formalizing allocation bans. That's why advisors are being told to bring it up proactively, and that is why we are seeing the early stages of steady, repeatable flows rather than boom and bust mania of earlier cycles. The takeaway is simple. When an institution the size of Bank of America moves Bitcoin from the fringe into the model portfolio, the conversation changes. It becomes less about guessing short-term price moves and more about positioning for a world where monetary debasement, structural deficits, and financial repression continue to shape returns across every traditional asset class. You don't have to swing for the fences, you don't have to time the cycle, you just need to understand the role that a small deliberate allocation can play over a multi-decade time horizon. And whether you choose 1%, 2%, or 4%, or many of you watching this video, 100%, the important thing is the largest players in wealth management are telling their clients that having zero is no longer the default. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and reshare so more people can see this. And of course, follow for more videos like this every single day. And check out Horizon. Horizon allows you to buy Bitcoin using your home's equity without new debt, monthly payments, interest charges, or term limits. To learn more and see if you qualify, visit joinhorizon.com or just scan the QR code right there. That's all for today's video. Thanks again for watching. I'll talk to you soon.